Hey guys, how we doing? Adding on to well, this is our last chapter. First of all, so we're adding on to the most previous chapter. We talked about fiscal versus monetary policy and how they kind of balance each other out, almost a check and balance. You hear that term about our political system a little bit. And we're talking about the Federal Reserve today, and basically they're kind of the boss of the banks. Okay, and again, this is kind of the answer to some of the challenges that fiscal policy faces from the president and Congress, where they don't like to make tough decisions, or maybe they have too much power to do whatever in certain cases. And so the Federal Reserve actually is it's not necessarily in the Constitution. It's actually a new word started in 1913. Okay, that again is going to regulate the banks, and they were formed for a few different reasons. One of the main reasons was that people didn't trust banks, and so I mean, and they've come up with some new rules. For example, probably the biggest rule, the most famous rule, is they created the FDIC, which is the insurance of your money if the bank loses it. Which, how does a bank lose money? Well, theoretically, they could get robbed. They have insurance for that themselves, but if they loan your money out and the people don't pay it back, the bank loses. And if the bank were to lose a whole lot of times, right, your money is insured inside that bank up to $250,000. And so that was one of the reasons they were formed. Like I said, it's also a little bit of a check and balance to only having fiscal policy as a economic fixer, so to speak. Remember, we're trying to fix unemployment and inflation, sorry. And anyway, we'll talk about how they do it. I'll go through it quick. These people are not. They are not elected by us, and so they can make some decisions that are maybe a little bit less popular. In fact, I would assume that most of you guys can't name anybody that is even on the Federal Reserve Board of Governors who makes the decisions. If you do know one, it's probably this guy. His name's Jerome Powell. These guys are appointed by the president. It's similar to Supreme Court justices, except for the fact that they don't serve life terms. Okay, they serve 14-year terms. So they get a new person in there probably about every 2 years. Okay, and then they just kind of keep rolling them through. And like I said, part of their anonymity is probably an advantage to allow them to make some decisions that might slow the economy down. Okay, which the way that they do that is they influence interest rates. All right. Again, they watch over, making sure smaller banks don't screw things up. This is the Federal Reserve Bank, and then these guys around here, right? They tell the Federal Reserve Bank what to do. You don't really necessarily need to know all those specifics. Okay, broken into 12 divisions. All right, and one thing that you might hear is that the Federal Reserve regulates the money supply. Okay, remember, if banks aren't allowed to loan money, it's probably going to be bad for the economy, because if I'm a really rich person and all I do is save my money and every dollar that I earn, I just save, that's not good for the economy. It's not creating incomes for anybody. And so by people saving money in banks, right, people can borrow that money. It creates flow of money, and people are able to create incomes for people by using that money. Now, it can be abused, right? We can borrow too much money and then be stuck having to pay it back all the time. That can happen too. But anyway, that is what you've got to understand that happens. Okay. Um, the term fractional reserve banking. So basically, the Federal Reserve is going to have three techniques they can use to change interest rates. Okay. Now, for us to understand how this works, is we're going to compare money to a grocery store selling bananas. All right. And the reason we're doing that is if the grocery store doesn't sell bananas, the problem with selling bananas is they go bad really fast, right? They turn brown, then no one definitely wants to buy them. So if the grocery store has these bananas for a long period of time, they've got to lower the price to get rid of them, right? Well, banks are kind of the same way. They don't want to hold on to money in the safe. Number one, inflation is occurring, okay, which means the value of the money is decreasing inside the safe, right? Number two, this is how banks make money, right? It's if no one's borrowing the money, then no one's paying to borrow the money, and the bank is not creating any revenue. Okay, so anyway, the first thing that the Federal Reserve does is they set a percentage of how much money a bank can loan out. Okay, right now it's set at 10%. Okay, so if they wanted to change that amount of money a bank could loan out. That's going to either, let's say that they lower the reserve requirement. And keep in mind, look what I have here. I have this little chart. So increased money supply, expansionary policy, loose money policy, lower the percentage of money that needs to be held on by the bank. So if the percentage is 10%, okay, and the bank all of a sudden hears that we're trying to lower this reserve requirement, now the bank has an extra 5% of people's money that they can loan out. They have to sell more bananas, okay, at the end of the day. So how do they do that? They're going to lower the price of the loans. They're going to lower the interest rate. People that, when you buy money, okay, when you borrow money, or you're buying it, how much you're able to get is affected by the interest rate. Okay. Now I kind of have this little chart here. If there's 100,000 total in savings, right, and we set it at 10%, then the bank can loan out 90,000. If we set it at 20, they can only loan out 80,000. If we set it at 5, they can only loan out 95,000. And so it just kind of gives you a little bit of a visual. Also note that this is the least often used. Now, this reserve requirement is the basis for the next two techniques. Okay. We'll talk about one more today. The next one we'll finish up with on Friday. Okay. So the next thing that we need to understand, okay, is that if the bank loans out too much money, and how do they loan out too much money? Well, if they loan out too much money, they could do that. But maybe more specifically, if someone comes and withdraws a big savings account, okay, then that would get them below their percentage. Okay, now if they go below that percentage, okay, the bank only has one option. All right, they have to borrow that money from another bank or the Federal Reserve, usually another bank though. Okay. So they've got to borrow that money from another bank. Sounds kind of weird. Okay. But that's what the banks have to do if they go below that. Now, just like when you and I borrow money, the bank has to pay an interest on that loan. Okay. Which is going to cut into their profits. Right. And so I compare this to the speed limit. Okay. And I'm asking you, just to kind of think for a second, does the government want you to speed? Right. Okay, so just kind of think about that for a second. And I hope that you're kind of saying, well, you know what? Maybe they kind of do. And the reason that they might want to is, number one, it creates a revenue for the court system, right? And a speeding ticket's about $150, and we all have our little, number that we speed by, right? My number's like 8 miles an hour on the interstate. I'm kind of getting old, so I don't go as fast as I used to. But anyway, like 8 miles an hour on the interstate. Now, that is based on having had a ticket before, and that $150 ticket kind of sucks, right? And again, maybe some other factors, age, quality of my vehicle, right? Those types of things, that's the number. Now, when we say, does the government want you to speed, if they lowered that, okay, penalty, let's just say the penalty for speeding was $5, right? How much more often would you speed? A whole lot more, right? Because the penalty is not very low. And so when banks don't have to pay a very big penalty, they're going to get real close to that 10% reserve requirement all the time. Okay. Now, let's say the fine for speeding was $1,500, right? Where it's like, oh my gosh, $1,500, that's a big chunk of money, right? Now my number is not like 8 miles an hour over. It might be like 1 mile an hour over, right? And, so same thing with banks. If the penalty is really high that they are going to have to pay, then they're not going to get anywhere close to that 10%. Okay. So those are the two that we're talking about today. We'll talk about the third one on Friday. I'm sorry, this is for Friday, for Monday. All right. And that'll finish us out. I'll give you the final exam assignment, and that'll basically be closing things out. So we've made it. All right. We've got a few more little things that we've got to do, but we'll get them done. Okay, so for your assignment today, okay, first of all, you'll want to go into Google and type in mortgage calculator. And it's going to take you it's going to look like this. It's going to say monthly cost. It's going to ask you like your buying. Now, here's what I want you to do though. I want you to click on the maximum loan part, okay? And however you want to decide how much money you think you could pay a month for a home. Okay. Um, I want you to. So obviously, if you have a job, you could have fun with it. Obviously, none of you are earning the amount of money you want to earn for the rest of your life. Okay, but if you're working full time, $10 an hour, or whatever, and you bring home 325, $350 or whatever, you could type in that $350 in here. Okay, so I'm just gonna make a very well, I'll show you what I'm doing here in a second. I'll change the numbers for you. So, or you can say, all right, I'm going to make, or my goal is to make $60,000 a year. Divide that by 12, okay, which would be in this case $5,000 a month, and say, okay, I think I would be able to afford to make $1,000 monthly payments. Okay, so you're going to type in what you think you could afford. So I'm just going to throw in a nice round number, $500. Okay, now what you're going to do is you're going to pick whatever payment it is. All righty, now and then you're going to show me how much you could pay for a house. So what this is showing me is I can make $500 monthly payments. Okay, and that's going to allow me to borrow $118,000. Notice I have 3% right here. Okay. I want you to do it for 3%, for 5%, and 7%. Okay. So you've got to give me three numbers. You're going to give me your monthly payments, interest rate at 3%. In this case would be $118,595. Interest rates at 5%. Obviously, that number goes down. That's showing us how much less money we can borrow if the Federal Reserve affects these interest rates, right? And if it was at 7%, how much I'd be allowed to borrow. Okay, so you're going to do that. You have to use a number different than 500. Okay, but you can kind of tinker around with it too. You could do this with, there's also a car payment calculator. I won't take your time up and show you that, but you guys might be closer to borrowing money for a car than a house, but something that you could do. Okay. So your assignment, pick out your monthly payment, 3%, 5%, 7%, send me those numbers. We will talk to you again on Monday.